Imagine waking up and just watching $200 of value evaporate from an ounce of gold.
Yeah, just vanish.
Literally in just 72 hours.
Yeah.
And, that is exactly what waking up on the morning of June 25th, 2026 felt like for anyone holding precious metals.
It was a brutal morning, to put it mildly.
Right. I mean, the psychological bedrock of $4,000 an ounce didn't just break. It completely dissolved.
Absolutely shattered.
We are looking at a pricing landscape that has moved past a simple correction and straight into, well, systemic capitulation.
Hey everyone, before we jump into today's deep dive, make sure you hit that like button, subscribe to the channel, and leave a comment down below with your thoughts. Your support really helps us keep this going. We are looking at a stack of global precious metals market reports and strategic outlooks for June 2026. And the dominant headline across all of them is the battle for $4,000.
It's a massive psychological level.
It really is. So our mission today is to tear the situation down to the studs. We're going to unpack exactly why gold and silver are experiencing this massive sell-off, determine if this is just a temporary bleed or, a fundamental shift, and extract the precise strategies recommended for you to navigate this volatility. We're joined by our senior market analyst to help make sense of it all.
Thanks. And I'll say right off the bat, context is going to be your absolute best defense mechanism today.
Right.
Because when you look at the raw numbers on a screen, they look dramatic, terrifying even if you happen to be over-leveraged. But panic is the enemy of strategy here.
For sure. Panic never pays out.
Exactly. So our goal is to synthesize what is actually happening beneath the surface, spot the patterns in the capital flow, and, translate all that noise into actionable insight for you.
Okay, so let's look at the actual blood on the streets. Before we dissect the macroeconomics, you need to know what happened on the ground last night and early this morning. The numbers for gold are incredibly stark.
Stark is an understatement, honestly.
Yeah. After 3 consecutive days of severe decline, wiping out roughly $200 per ounce, gold officially broke below the massive psychological barrier of $4,000 an ounce.
Which is huge.
It hit a low of around $3,965 last night. Now, this morning, it has bounced back slightly into this highly sensitive, the reports call it a tug-of-war phase.
Right. The buyers and sellers are just exhausting each other.
Exactly. It's hovering violently between $3,980 and $4,000. Overall, gold is down over 13% just this month.
And, silver paints an even bleaker picture, actually.
Yeah, let's talk about silver.
Silver dropped earlier and deeper than gold, losing about $9.50 an ounce recently. It completely shattered that critical $60 support level.
Wow.
Yeah, hitting a low of $56 yesterday. Currently, it's hovering around $57.50. That puts silver down over 22% for the month.
22%? That is wild.
I mean, to see a global asset contract by nearly a quarter in 30 days, that's a violent unwinding.
It really is. I always look at silver as, the canary in the coal mine for the broader metals market.
That's a great way to look at it.
Because it has that dual identity, right? It's a monetary metal, but also a heavily utilized industrial component, so its demand metrics shift faster.
Right. Speculative capital flows in and out of silver much quicker than gold, which makes it far more volatile.
Exactly. So since silver usually reacts more violently and earlier than gold, and the sources note silver is now starting to trade sideways in a narrower range, I have to wonder about the sequence here.
What do you mean?
Well, does silver stabilizing mean the fast money has exited and the worst of the pressure on gold is lifting? Or, are we just sitting in the eye of the hurricane right now?
That canary analogy is perfectly applied here. When silver narrows its daily trading range and stabilizes around that 57.50 mark, it tells us something very specific about market mechanics.
Okay, what's it telling us?
It suggests that the aggressive, indiscriminate algorithmic selling phase might be exhausting itself.
No, interesting.
Yeah. The highly speculative traders who were forced out via margin calls, they've already been liquidated. So when silver stops plummeting, it often signals to the broader market that a temporary floor is being established.
Right. So the immediate sheer cliff drop is pausing.
Exactly. It's transitioning into a tense standoff.
A standoff for the $4,000 gold line. That makes total sense. We see the sheer scale of the drop, but we need to trace the domino effect that actually triggered it.
Right. It didn't happen in a vacuum.
No, the reports point to 4 specific macroeconomic forces pushing prices down. And they aren't isolated events. They're chained together in a massive reaction. Let's start with driver number 1. the Federal Reserve and the latest inflation data.
Yeah, everything happening to gold today starts with the May core PCE data.
The personal consumption expenditures.
Correct. It's the inflation gauge the FED monitors most closely. Now, the market consensus had priced in an expectation of 0.2%.
But it missed.
Right. The actual number came in at 0.3%.
Which is funny because to a regular retail investor, 0.1% sounds like statistical noise. Like, who cares, right?
Oh, but in the institutional world, that 0.1% is an earthquake. It completely rewrites the algorithmic models for the entire quarter.
Because a hot inflation print tells the Federal Reserve that inflation is sticky.
Exactly. Meaning they cannot lower interest rates. They have to remain hawkish.
Wait, let me push back on a common assumption here. I thought gold was a safe haven. If the economy is tense and the Fed is acting tough, shouldn't gold go up?
You'd think so, but that's the trap. Because gold yields no interest. It doesn't pay a dividend.
Right, it just sits there.
Exactly. So when the FED signals they are keeping interest rates elevated to fight that sticky inflation, holding a non-yielding asset comes with a massive opportunity cost for institutional managers.
Which sets off the second domino, the US dollar. The sources note that the DXY, that's the index measuring the dollar against a basket of major foreign currencies, has surged to a 13-month high of approximately 101.5.
Yeah, a hawkish FED naturally strengthens the dollar because higher U.S. interest rates attract global capital looking for yield.
But what I find really fascinating in these reports is the mechanical effect this has on physical gold demand globally. Since gold is priced in U.S. dollars, a surging DXY acts as a massive tax on the rest of the world.
It's a profound wealth transfer mechanism. Well, imagine you are a jewelry conglomerate in India or a sovereign wealth fund in Asia looking to acquire physical gold. You fund that purchase with your local currency, right?
Right.
When the DXY spikes to 101.5, your local currency suddenly buys far fewer U.S. dollars. The intrinsic value of the gold hasn't changed at all, but the actual cost to acquire it just skyrocketed for you.
Oh, wow. So this mathematical reality crushes their purchasing power.
Exactly. It actively chokes off buying pressure from outside the United States.
So foreign demand evaporates because of the currency exchange rate. But domestic demand is also getting crushed by the third domino in our chain, U.S. 10-year Treasury yields.
Risk-free rate.
Right. The sources highlight that yields are sitting really high, right around 4.4%. And this is where the institutional mandates come into play.
Yeah, the capital flow here is entirely mechanical. Institutional investors, like massive pension funds, they operate on strict risk-adjusted return mandates.
They can't just gamble.
No, absolutely not. The 10-year Treasury is the global benchmark for a risk-free return because it is backed by the U.S. government. When that risk-free paper offers a guaranteed 4% annual return for a decade, it acts like a giant vacuum.
Sucking money out of metals.
Exactly. Fund managers look at gold in their assets struggling to hold a psychological support line, and then they look at a guaranteed 4.4% yield. Their fiduciary duty actually forces them to sell the volatile metal and buy the stable paper.
It's not an emotional decision, it's a mathematical reallocation.
100%.
And then the final piece of this macro puzzle cuts the legs out from under gold's primary marketing narrative. We're talking about cooling oil prices.
Driver number 4.
Right. WTI crude is down to around $69.90 a barrel, and Brent crude is around $73.50. Energy is the ultimate cost input for the global supply chain, you know?
Absolutely. When oil drops this significantly, it dramatically lowers the cost of shipping, manufacturing, and raw material extraction.
Which eases the immediate fear of runaway inflation.
Exactly. And historically, the dominant thesis for owning gold is as an inflation hedge. Investors allocate capital to it to protect their purchasing power when the cost of living spikes.
But if oil is cheap,
If energy prices suggest the broader inflationary fire is actually cooling down, gold loses that specific utility.
the demand for the hedge just evaporates because the perceived threat is gone. So we have this brutal 4-part sequence. Let me recap it.
Go for it.
A hot inflation data point forces the FED to keep interest rates high. High rates spike the value of the dollar, destroying foreign demand. High rates also push Treasury yields to 4.4%, draining domestic capital into government bonds. And finally, cheap oil convinces the market that long-term inflation is contained anyway.
It is honestly a miracle gold is even putting up a fight at $4,000 given that fundamental backdrop.
Seriously. It's fighting gravity on 4 separate fronts, which forces us to evaluate the timeline of these pressures, because the sources draw a very sharp dividing line between the short-term reality of the market and the long-term structural reality.
Yes, the timelines are completely disconnected right now.
In the short term, the picture painted by these reports is incredibly bearish. The market is trapped in a highly reactive, news-driven phase where technical algorithms are dictating price action.
And that's why the $4,000 mark isn't just a number, it is a psychological battleground.
Right. The reports outline very specific parameters here. They say the critical support floor is established between $3,950 and $3,980. And the resistance ceiling, the hurdle it needs to clear to confirm any sort of recovery, is up between $4,020 and $4,080.
And the mechanics of that 3950 floor are critical to understand. Institutional traders place automated stop-loss orders just below major psychological levels.
So if it drops below that,
If gold convincingly breaches 3950, it triggers all those automated sell orders, cascading into further price drops. The downward trend expands aggressively because the selling literally feeds itself.
yikes.
But conversely, if the buyers can absorb that pressure and push the price above 4,080, short sellers are forced to buy back in to cover their positions, which can create a legitimate technical recovery.
Okay, so that's the short-term bloodbath. But the sources also make a really compelling argument that the long-term reality is actually bullish. They state that the foundational structure of a bull market remains completely intact,
Right.
because the current strength of the US dollar is predicated entirely on short-term FAD rate expectations, basically betting on what the central bank will do at their next meeting. It is not a reflection of the long-term structural health of the U.S. economy.
Exactly. The foundational pillars supporting the precious metals complex over a multi-year horizon haven't moved an inch.
Like what?
Well, the U.S. national debt continues to expand at an unprecedented rate. We're witnessing a steady decline in global trust regarding fiat currencies. Central banks, particularly in the BRICS nations, are accumulating physical gold at record paces to diversify away from the dollar.
And geopolitical instability remains a constant threat.
Right. A 0.1% miss on a monthly inflation report does not resolve any of those massive systemic vulnerabilities.
Okay, I see the logic, but there is a massive cognitive dissonance here.
How so?
Well, how do we reconcile a market that is in total panic right now, dumping gold at a rapid pace with a long-term fundamental outlook that remains unchanged? It sounds like a massive contradiction. Are the traders driving this sell-off just incredibly short-sighted, or is something else at play?
That's the key question. And you have to view this through the lens of liquidity versus solvency.
Liquidity versus solvency. Break that down for me.
The market participants driving this current sell-off are institutional traders and hedge funds. Their performance is measured quarterly, sometimes even monthly. They are mandated to chase immediate yield and manage short-term risk. They are not making a 10-year bet on the U.S. debt crisis. They're making a 3-week bet on the Federal Reserve's next policy statement.
Oh, I see.
If the capital flow dictates a move into treasuries today, they must execute that move today to maintain their liquidity and performance metrics.
So they are just optimizing for the immediate tape.
Yes, but contrast that with sovereign wealth funds and central banks. Those entities are playing a multi-generational game of solvency.
Right, a whole different time frame.
Exactly. They are not concerned with a $200 drawdown in a single week. Their mandate is to secure assets with zero counterparty risk to backstop their national economies over the next 2 decades. The short-term traders are reacting to the weather, while the long-term entities are preparing for the climate.
That is a brilliant way to put it. The weather versus the climate. And that brings us to the most practical part of our analysis today. How you, the listener, should actually navigate this environment.
The survival guide.
Exactly. With this complex macro puzzle and these conflicting timelines, you need a strategy. The sources divide their tactical advice into 2 distinct approaches based on your investment horizon.
Right.
Let's look at strategy A first, the long-term holder. These are the investors who bought into the market at the recent high range, somewhere between $5,400 and $5,600 an ounce. They are taking a heavy paper loss right now.
They are. And the most crucial directive from the strategic outlooks for the long-term holder is to avoid panic selling.
Just hold the line.
Right. Liquidating a long-term asset during a short-term, liquidity-driven panic is the absolute fastest way to permanently destroy wealth. And the second, equally important directive is to avoid using fresh capital to average down during this specific phase.
Now, averaging down is such a common instinct, though. When an asset you believe in goes on sale, the natural reaction is to buy more to lower your overall cost basis. Why do the reports advise against that right now?
Because in a tape-driven market where algorithms are actively hunting for stop losses, we have not confirmed a true bottom.
You don't want to catch a falling knife.
Exactly. Throwing new capital at an asset in freefall dramatically increases your risk exposure before the market has established a stable floor. If your original thesis was based on a 5 to 10-year horizon, that thesis remains valid. Treat the metal as an accumulated long-term asset. Lock it away in the drawer.
Turn off the daily price alerts.
Turn them off, ignore the short-term noise, and preserve your remaining dry powder.
Preserve capital and wait for the dust to settle. Makes sense. Now, stratagem B, on the other hand, is for the short-term capital optimizer, the active participant who's actually looking to trade this immediate volatility.
A much riskier game right now.
It is, and the sources introduce a really fascinating psychological framework here. They reference a proverb from the reports that basically translates to gathering small pennies steadily.
I love that concept.
Yeah, it means filling your bag by consistently collecting small, safe gains instead of holding out for massive wins.
It is a brilliant risk management philosophy for an erratic market like this. The core premise is acknowledging that the broader market forces are entirely in control right now. You are not.
Right.
This is not the environment to swing for the fences or attempt to capture some massive $500 reversal rally. You are playing the technical bounces with extreme caution.
And the technical mechanics of that strategy are very specific in the reports. The advice is to target a buy-in strictly at that strong support floor we discussed earlier, around the 39.50 to 39.60 level.
If it hits that floor and actually holds.
Right. If it holds, you enter. And then you take your profits very aggressively at a modest target of around $4,100.
Take the small gain and immediately step back into cash.
Yeah.
You were just gathering pennies.
Exactly. The reports are also emphatic about discipline here. Do not chase sudden intraday rallies. If the price jumps before your order fills, just let the opportunity pass.
Let it go.
And above all else, the use of high leverage or borrowed capital is strictly warned against.
Oh, using margin when an asset is proving it can swing $200 in a matter of days is a mathematical death sentence for a retail account.
100%.
One algorithmic spike in the wrong direction, and your entire portfolio is liquidated. The gathering pennies mindset is fundamentally about the preservation of your core capital first and generating modest growth second.
It requires an immense amount of discipline to trade a market this volatile without getting chopped to pieces. You take only what the market safely provides, and you retreat.
Exactly.
So bringing the entire landscape back into focus for you. As of this morning, June 25th, the market is shifting its posture. The sheer cliff, aggressive selling has transitioned into a phase of highly cautious observation.
The bleeding has slowed down.
Right. Supported by the stabilization we're seeing in silver, but a true trend reversal back to the upside has not yet been confirmed. We are locked in that tug of war.
Which means your mandate moving forward is to monitor the 4 macro levers we outlined.
Give us the checklist.
Keep your eyes on the DXY to gauge international demand pressure. Watch those 10-year Treasury yields to track institutional capital flows. Monitor Brent crude oil as the leading indicator for inflation expectations, and carefully parse any language coming from the Federal Reserve.
Those levers will ultimately decide if $4,000 holds as a floor or breaks as a ceiling. It really is a masterclass in market mechanics.
It's fascinating to watch unfold.
But before we wrap up, I want to leave you with one final thought to mull over an angle that builds on everything we just discussed, but wasn't explicitly spelled out in the daily reports.
Okay, what is it?
We talk heavily about the paper market, the algorithms, and the institutional mandates driving prices down. But physical gold actually has to be pulled out of the ground.
The mining sector. Yes. Mining operations are incredibly capital intensive, and they are heavily reliant on energy. If this high interest rate, strong dollar environment artificially suppresses the price of gold below $4,000 for a prolonged period, while the cost of heavy machinery and labor remains high, many physical mining operations will literally become unprofitable.
They'll have no choice but to halt production.
Exactly. So ask yourself, if the paper market creates an environment that forces miners to shut down, creating a massive physical supply shock down the road, right at the exact moment global central banks are hoarding physical reserves, What happens to the price of a hard asset when the paper manipulation finally breaks against a wall of zero supply?
That is the ultimate tension between a paper contract and a physical reality. It is a fundamental friction that eventually has to resolve itself.
It really is something to keep in mind the next time you look at your portfolio and see the algorithms panicking. Keep watching those macro levers. And hey, if you found this deep dive valuable, don't forget to like this video, subscribe to the channel, and drop a comment below with what you think happens next. Until next time.